Okay, welcome back, guys. Today we're going to take a look at a stock that is a perfect example of one that I would never own. It's Franklin Resources, ticker BEN, and here's the 5-year chart. They're down 28% in the past 5 years. Obviously, they've done horrible compared to the S&P 500, and their all-time chart. I don't really like these types of charts. They're very choppy ever since about 2006 and yeah, down since 2006. So maybe it's a buying opportunity, but most likely this is actually just a dying business, and I'll show you why. So they are a $12 billion company, still pretty large, and their price to earnings ratio is 13, so that's fairly low. Not bad there, although their revenue growth is declining, so that's a bad sign. But yeah, their dividend yield at 5%, so that's the one good thing about this company is at least they're making some money and they can pay it out in dividends. Let's take a closer look at their financials here. Take a look at their statements, and we could see it's negative revenue growth almost every single year except for 2021. And guess what? The only reason that is positive in 2021 was because they did an acquisition. So otherwise, this is a completely dying business. I would expect minus 4% moving forward. If you don't know what Franklin Resources does, well, they actually put together mutual funds. I don't know if you've ever heard of these mutual funds before, but I don't think they're very good. And also, the mutual fund is going the way of the dodo birds. So, um, yeah, mutual funds are dying. People would rather invest in ETFs, and Franklin Resources makes most of their money off of the fees on their mutual funds. In fact, they make about 90% of their revenue is on investment management fees um, in the United States, Luxembourg, and Asia Pacific. So, yeah. Otherwise, we can take a closer look here, look at their balance sheet, and they've actually been taking on debt. Wow. Okay, so this is when they did their acquisition, I'm guessing, between 2019 and 2020, and that's when they took on a ton of debt, absolute crapload, and they've actually taken on more and more debt over the years, and now they're up to 7 billion in debt. So that's not a good sign, especially when their cash flow is declining. Yeah, or their revenues are declining. You don't want to see the balance sheet taking on debt and revenues declining. That's a bad sign. Yeah, they paid dividends. They bought back some stocks, so they're not doing any dilution. Let's take a look at their stats here. Their ROIC is very low. That's not good. Gross margin is very high, and they do have some decent margins. Looks like over the past 7 years, it's been between 10 and 20%. I'd probably expect maybe like 14 or 15% moving forward. I wouldn't want to predict it too high. Let's take a look at the analysts. Well, I usually use the analyst predictions. So there's 11 analysts covering this, and I use these analyst projections in my forecast for the DCF model. And let's look at stats, see what their short percentage is. Yeah, their short percentage is 7%, so that is very high. That's a very big red flag, and that's a signal to avoid this company unless you know something that most investors don't. So yeah, that's a big red flag. Taking a look at the DCF model, let's zoom in on this. Yeah, I put the estimates here. Buybacks of 150 million, net debt of 9 billion, discount rate of 10% because I want a 10% return on all my stocks, exit multiple of 12 because this is a dying business. And yeah, I feel that 12 is very fair for this. Growth of 0% in their earnings. Now, really, I think this is going to be negative, so I think this paints a rosy picture for the company. And yeah, in this case, the fair share price is $26. Woohoo! Well, actually not. Well, they have lots of debt, so when you factor in the debt, they're actually not worth very much, about $9. I'm using this model. I put them at a fair share price of about 18, maybe 17. But I also think that their earnings are actually going to decline. So yeah, I think it's actually lower than this. And going to the revenue margins model, well, I have revenue growth of 0%, even though it's been declining by 4% over the past, 6 years, and it probably will continue in the future. Profit margin of 19%, that's kind of what they're predicting based on the analysts. And they actually don't really do 19% profit margins very often. So I brought their profit margin back down to 13%, more of a historical average. And in this case, we can see that they are overpriced at this moment. Yeah, fair share of $18. And I also think their revenue growth is going to be negative 3 or 4%. So this is actually a good scenario for this business. And as you can see, it is overpriced even with optimistic scenarios. So definitely avoid this business. I wouldn't go short either. Like, even though there is a lot of people going short, I would not do that. But yeah, that's what I think. Let me know what you guys think in the comments. Let me know if you have ever invested in one of the Franklin Templeton funds. Let me see if I can actually find one of their funds. Yeah, Franklin Templeton, like all of these different holdings, these are just mutual funds that they have. And then they've got, yeah, they charge fees on them. That's how they make their money, 0.29. But yeah, make sure to hit that like button, and I'll see you in the next video.